And we are back with a brand new Chart This with Gary Wagner. Gary now joins me from Hawaii. Gary, so nice to see you again.
Good morning. How are you today, Daniela?
Doing great, Gary. Just readjusting to everyday life. And I hope you can help bring me up to speed on what we've seen in the markets these past 2 weeks and what we should expect.
Yeah, I think you picked a good time to take a couple of weeks off. It's been very, very quiet. But one thing that I'm noticing is that in terms of a technical basis, we are going towards what's called the conclusion of a compression triangle. And typically, that type of pattern will release the pressure once it hits the apex of this pattern. So we could see a sizable breakout in the market in the next week or 2 weeks.
So at what level could we see a breakout, Gary?
Well, right now, it's got to go over about 1635 basis cash. And once it does that, then it's actually gone over the former top that it had in the market. And then I think that it would be clear sailing probably till about 1705. That's the next resistance area. We do have really good support, though, at 1580. It's been tested on more than a number of occasions, and it's built a good base. The question is, does it have the energy or the power to really accelerate in price?
So, Gary, many analysts I've been speaking to this week have told me, look, we really have to wait for September to roll around to see some action again. Do you agree?
It could easily be. We're absolutely in the summer doldrums. But the techniques I use are not really valid for time, and so we're just using basic judgment on that, and September could be very logical.
So is this a good buying opportunity for gold then, Gary?
I think that we have a very, very strong base in gold right now between, say, 1580 and 1610. It's trading roughly above that right now. My sentiment is, for physical buyers, absolutely accumulate at this point. I don't think that the market is going to go to 1400 or to 1530.
So, Gary, when you do look at that 1635 price point, do you think it will be an orderly ascent?
You know, that's a good question. My personal belief is that if the pattern holds true, and realize the pattern is really a reflection or a way to analyze fundamental data. But in this type of pattern, typically it's a rapid ascent rather than if what you mean by orderly is a small succession as it moves up, typically you'll get a breakout where it really accelerates as it moves up.
So, Gary, I don't want to keep you from your next educational segment. Let's start. We'll be looking at Elliott wave charts today and how we can use them, correct?
Yes, an Elliott wave is very, very controversial in that there are some technicians that swear by it and some technicians that swear at it. They don't see any merit to it. I have found that Elliott wave, when properly used, can be incredibly insightful in terms of markets and how they move.
All right, well, without further ado, let's get started. Gary, walk us through Elliott wave charts.
I think you're going to find today's session quite interesting. What I want to do is kind of go over very, very briefly the topics we've already covered as we look at gold. And then I want to incorporate a couple of Western technical indicators. One, MACD, simple moving average convergence divergence, and then what I consider to be probably one of the more difficult techniques to learn, but I believe one that offers incredible insight, and that is Elliott wave. There's a couple of things that become very, very evident when we look at this market. We talked about the channel lines, the trends that took this market to these record tops. We looked at the actual retracement level as one that was a 38% retracement level, and we talked about the fact that with these Henkin Ashi candles, you get a real clear indication of current trend and strength of that trend. Obviously, very, very strong. And what we have noticed lately is that we have had a series of lower highs, a flat bottom, and that's really forming what's called a pennant or triangle formation. You can also see that the Henkin Ashi candles have gotten very, very small, and they're kind of alternating between green and red. There's no real clear defined trend as of yet. But there's a couple of indicators, a couple of things right now that are pointing to a potential bottom in the market. First one is moving average convergence divergence. It is an excellent study to incorporate with Henkin candles. Why? Because typically what you'll see is that when you reach these pivot points, you'll go from green to red. At the same time, you'll notice that the MACD tends to cross right at that area. Now, I have set my moving average convergence divergence to 12, 26, and 9. You can also see that as the market comes down, you get a sense of a buy, but that quickly fades as it moves back into a sell. That's this. And right now, what are we looking at? Well, we are looking at the fact that on a weekly chart, the moving average convergence divergence appears as though it's about to cross. Absolutely, the market is very much oversold. And so that's the first indication that we really could be looking at a nice breakout to the upside. But the real indication comes when we add to this mix Elliott wave count. Looking at a weekly chart, this weekly chart is in Heikin-Ashi format. It does have the MACD, moving average convergence divergence. We are using Fibonacci, but we're going to introduce one last element right now, which is Elliott wave theory. Elliott wave theory is simply the idea that markets move in patterns and that those patterns tend to repeat themselves to a degree with variation over time. What you'll find is that as you get deeper and deeper into your study of technical analysis, the best indicators are ones which attempt to understand and translate, so to speak, market sentiment, to mathematically quantify how people feel about a market. Now, in essence, the way that Elliott wave works, and I'm only going to explain a bullish cycle, but the way that it's composed is each bullish cycle is composed of a total, of 5 waves, and then 3 waves. The first 5 waves are 1, 2, 3, 4, and 5. Where 1, 3, and 5 are what are called the impulse waves. And then the corrective waves, these down waves, are going to be 2 and 4. It's always going to be like that, but there'll be variations off of that. Then you go into what's called a simple correction, which is A, B, and then a C. So you have a total of 8 waves, 5 in the impulse section, 3 in the corrective stage, and as long as the bullish cycle continues, you will get a count like that. So this is what we call our long count right now that I'm working on in gold. And this long count, of course, starts back at, as you can see, this is 2008. The market comes down and completes a cycle right at the conclusion of 2008. So the count that I'm looking at, a long count, is 1, 2, 3, 4, and then we should have one last final 5th wave to complete this 5-wave series or section. To me, this is where it really gets interesting, when we put all of this information together. And what we're looking at is this. When we look at the current state in gold, and this, without a doubt, whether you want to call it a wedge or a compression triangle, Elliott wave has actually identified a pattern which he says appears as a 4th wave typically. And in that, rather than it having that classic, you go up to the top and then you get an A, B, and then C, it is a compression triangle. And according to Elliott wave, it is composed of 5 legs. Now, the way that the count would work is as follows. After hitting our record top, the market retraces, and this is the first leg. It's got to touch the bottom. Second leg. This, on my count, is the 3rd leg. We've had this failed 4th leg, and one of 2 things, in my opinion, are going to happen. Either the market will trade back up to this resistance here with one final leg, that 5th leg, And then we'll get what is called the thrust. The thrust, of course, is when price breaks out above this compression triangle. The other alternative is, because this has been so elongated, that a possible count could very well be 1, 2, 3, and then a break to the upside. Now, first thing. The second thing with Elliott Wave is that the belief is that these 3 impulse waves, 1, 3, and 5, are going to be of about equal length in terms of price move, with 3 typically being the longest, but it cannot be the shortest. What I mean to say is that if we go into a major 5th wave, if that's correct, 3 to 4 will take us to this 1520. We will reach a new contract high on wave 5. And to me, that's an incredible, incredible thing to think about. Elliott Wave.
Gary, as always, so informative, and I always ask you this, do you still have more in store for us?
Absolutely. There's a lot more in store.
Thanks so much, Gary. We'll see you next week. In the meantime, you can email me any comments and questions at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.